Well, hey, happy summer to our listeners. I'm Kate Fishbein. I am here with Tom Farrell, my co-host. We are Amplified Wealth According to Plan. And welcome. I think we got a great topic today. And something that, people can really plan ahead for, because this is something that you want to make sure you're giving yourself some runway to think about where this topic might fit in.
Yeah, I was going to say, we're, as we sit here, I can't believe we're almost halfway through the year. It's just
we're almost third quarter. Almost third quarter here.
Kids just got out of school, right? So now we're in the summertime routine. But that gives us 6 months.
Wait, Tom, hold on.
Wow.
Is there a summertime routine? Well, or do the wheels come off? Because there are moments, yes, it is definitely more of a summer vibe, but
yeah, well, it's been interesting because my older one, he works now. So he's already into his work routine, which is good. And they're both swimming on the outdoor swim team for the summertime, right? So there's practices at certain times for that. So they've kind of, last day of school was last week or so. And then they immediately started to get into this swim thing.
Which is great.
Yeah, we just got to keep my daughter busy beyond that.
Yeah, and we've got summer soccer already started in our house. So, there's always something. It's always busy, but that's great. And so let's talk about the topic we're going to do today. And we're going to talk about QCDs today. And, why don't we jump right in to this topic? And Tom, I don't know about you, but everybody talks in letters. And
there's too many letters.
So many letters, RMDs. It's an alphabet soup. And so, what the heck are people talking about? What is a QCD? Can you help us?
Let me try. All right. So a QCD is a qualified charitable distribution. And these are distributions that investors can make out of their retirement accounts, their IRAs.
Right. So it's not all retirement accounts, it's IRAs.
Correct.
And when that distribution comes directly out of an IRA, it is, to a qualified charity, directly to a qualified charity. It actually bypasses those taxable income rules. But of course, there are additional rules, which we'll get into as well. And so again, the tax benefit here is that these qualified charitable distribution, or QCD amounts, are actually excluded from taxable income, unlike other standard IRA withdrawals. And, those standard IRA withdrawals, Tom, correct me if I'm wrong, I'm not a CPA, but those pre-tax IRA distributions, they come out as ordinary income. And that is a much more punishing rate than even say this, the capital gains rate. So absolutely. These pre-tax IRA withdrawals can make a big impact for individuals, particularly, when they hit required minimum distribution age.
Yeah, so this is an opportunity for IRA owners who are already charitably inclined to think about ways that they can, and you mentioned before, Kate, that, this, for the most part, this goes hand in hand with the concept of a required minimum distribution, right? QCDs are only allowed for certain individuals. You have to be 70 and a half years and older to do them. We'll get into some of those rules. But my point is that, if you just make your distribution out of your IRA, it'll be added to your tax return as ordinary income on top of any other income, that you're reporting. And that can be very expensive depending on, the total level of income that you have. So this is, a qualified charitable distribution with an opportunity to plan around two things. One, satisfying your charitable intent, and two, making sure that you're making those distributions out of your IRA as per IRS rules.
Great. Those are great points. And why don't we, let's dig into some of those key rules. Let's start off because, there's always rules, right? You hear that and you're like, oh, this is too good to be true. But everybody's not eligible. So let's talk about who is eligible. So as Tom mentioned, you have to be at least 70 and a half years old to qualify for making a qualified charitable distribution. Tom, I don't know about you, but we got to pause right there because that 70 and a half, I'm having flashbacks. I'm having RMD flashbacks.
Yeah, it's a holdover from the old R&D age, which was 7.5, and through the Secure
Right.
Act 1.0 and 2.0, they've moved the goalpost on that out to age 73 or 75, depending on what year you were born. But for whatever reason, Congress decided to keep the 7.5 marker for folks that are allowed to do qualified charitable distributions.
Yeah. And probably because this QCD rule was first put in place around 2015, 2016. And that's exactly, that was the RMD age at the time. So it just kind of lined up. And then this age hasn't been adjusted. But honestly, that could work to benefit some additional people. And one other thing I want to note here about this 70.5, right? So a lot of times we think in calendar year, but this 70.5 is a hard cutoff, which means even though you turn 70.5 in the calendar year, let's say I turned 70.5 in June, I'm not eligible for this QCD in March. You actually have to wait until you're 70.5 or older. So even though it's within that calendar year, watch out, you got to be at least 70.5. I'd have to wait until when I turned 70.5. I couldn't take it earlier in the year, even though I was turning 70.5 within that year. So that's like an important distinction that I want everybody to watch out for.
That's a good one.
Let's talk about what the eligible accounts are, because it's not eligible from every account.
Yeah, folks are still working beyond age 70 these days. And so unfortunately, 401ks are not eligible when it comes to QCDs. But traditional IRAs, inherited IRAs, and inactive SEP IRAs and simple IRAs are included. And that's, the inactive part of that is a key point because, if people are still making contributions there, that muddies the water in terms of, the deduction you would get for the contribution and then any kind of tax benefit you would expect to get from a QCD. So these need to be inactive SEP and simple IRAs. Typically, Kate, I would say if they're inactive, most folks would have probably already rolled those over to a regular IRA. But just it's a good point to leave out there in case there's anybody out there that has one of these types of accounts.
Great. And just one other little quick side note, remember under traditional IRAs too, a lot of times that falls like rollover IRAs too. And also, while we did a whole pod on why someone might consider rolling over a 401k into an IRA. So, be sure to watch that before you do so. But remember, if this is something you're interested in and hey, you've got money maybe in an old 401k, someone could roll over the 401k potentially into an IRA, again, making sure that it makes sense, and then be eligible for QCDs. So even though you might have a good majority of your funds in 401ks, maybe you still want to keep listening. This might still be useful.
Well, yeah, I mean, that's where it comes into the, everybody's situation is a little bit different. And so if that would make sense, then it's just something to think about for sure.
Right. Yep. One thing I want to mention there on the inherited IRA, you need to be 70.5, right? Just reminding individuals that. And that inherited IRA, remember when you have required minimum distributions, this is if the beneficiary is 70.5, not if the decedent was 70.5. So just want to make that, that distinction that the beneficiary on that inherited IRA needs to be 70.5. So just wanted to clarify that one little point.
Is the key number there.
Right, exactly. So all rules apply here, right? And then you want to make sure that you're doing this direct transfer from the IRA directly to the charity. So you don't want to take receipt of the funds, right? You don't want to have a check payable, Kate Fishbein IRA, payable to Kate Fishbein, and then deposit the check and then write the check to the charity. You want it to go from the IRA to the charity.
It has to, right? The mechanics here are very, very important.
Right. And now, hey, some custodians will write a check potentially saying, qualified charity from your IRA and then maybe mail you the check so you can hand deliver the check or whatnot. As long as the check, you're not taking receipt of the funds. It's not payable to you. It's payable to the charity. It's going directly to the charity. Hey, and you want to talk about some of those, the qualified charities and kind of,
Yes. So, there's been some questions out there about, okay, well, where am I allowed to send this? What is considered a qualified charity when it comes to QCDs? And the IRS has stipulated that the charity needs to be a qualified 501c3 public charity. You can't send a QCD to your donor advised fund or a private foundation. And if you're curious whether a particular organization that you want to support qualifies under the IRS rules, the IRS does have a website, Kate, that you can search your organization on. I took a little note
Awesome.
On this. So you can go to the IRS website, and there's a section called the IRS Tax Exempt Organization Search, and that's where you can type in your preferred organization. Just make sure they meet that criteria, and if they do, then you can proceed with your QCD.
Well, that's a great point. Like, check first, right? Better safe than sorry. Check if the charity is, going to qualify before you go through all this.
Right. Yeah. If you're gonna do this,
if you're gonna go through this effort,
let's make this count.
Let's not spin the wheels here, right? And maybe there are some community foundations, but really those are the biggies. Making sure that it's a qualified public charity for sure. And the other little point that I think we should clarify for our listeners is that, remember, this QCD excludes that amount from income, but it's not giving you a tax deduction. And remember, no double dipping. So, you're not getting an additional tax deduction. The QCD amount and that amount alone is going to be excluded from your income as long as you make all the, qualify for all the rules and whatnot. You're not getting a deduction. It's not a deduction. And oftentimes, that exclusion from income is going to be more valuable to your bottom line than even for, say, potentially a tax deduction. And some of that too is because, of those different tax limits for different deductions that you might qualify for, right? SALT deductions, that bonus senior deduction now, and then there's IRMA costs. So oftentimes getting that exclusion from income can be more valuable to you than having, a deduction potentially.
Yeah, it is a key point. I think the way that I think about this is that if you're going to do the QCD and it qualifies under all the rules, it essentially helps you satisfy your RMD, if you're of RMD age. And it's invisible in terms of reportable income. So it can be a great benefit. And you're right to point out the differences in terms of, not being able to, go through a tax deduction,
right,
if you're doing a QCD.
Great. So let's hop on over to some of the key benefits. And Tom, you hit the nail on the head, right?
Well, I think I knew what was on this next slide. Always, yeah.
What a beautiful transition. What a beautiful transition. No, but you hit the nail on the head, right? So that this can be used towards fulfilling those required minimum distributions. As Tom mentioned earlier, for people who are not already of RMD age, essentially if you're born before 1960, it's 73, 1960 and later, it's 75 years of age. So again, and, for someone who's done a really effective job of saving and growing their IRA balance, sometimes those required minimum distributions can be quite large. So
yeah, did we go over the allowable limits already?
It's coming up. It's coming attractions. It's coming attractions. Okay. Yep.
Yeah. I was just thinking about your point there about, how large a required minimum distribution could be, depending on how large the retirement account value is.
Yep.
And so, I would say, we're making this point about the RMD, and that's where we typically see these, Kate, come in, right? Is folks that, they're in the mode of having to take an RMD, so they are 73 or 75, right? But, back to our point before, technically, you can start this after 70 and a half, right? Where, you might not be subject to RMDs. And so it's an opportunity to say, listen, I'm going to take some money out of the IRA now, even though I'm not subject to RMDs. And again, it's invisible income, don't have to report it on your tax return, and you can still benefit a charity. I think every IRA owner would just need to, go through the analysis, whether that makes sense to do or not.
It's a huge point.
RMD offset, if you want to call it that, is one of the key benefits that we see when we're working with clients, and that's a key point.
It's a great point. And the one thing I want to circle back to here is, now remember the Secure Act, 2.0 changes with required minimum distributions for inherited IRAs. So it's very possible that and now we have to take not only required minimum distributions from inherited IRAs if you're under the new Secure Act rules, but you also have to distribute the funds within 10 years. So sometimes, you have this window of maybe you're not subject to required minimum distributions yet, but hey, I've got all this inherited IRA money and I need to find a good tax planning window for me to be able to distribute these funds. Maybe when I'm in a lower bracket before those big RMDs kick up on my IRA. And maybe as long as I'm 70 and a half, maybe this is an opportunity, if you don't need the money, as Tom mentioned, to start planning, hey, you know what? Maybe QCDs would make sense from my even inherited IRA to start not only fulfilling those required minimum distributions, but maybe start working down towards that 10-year rule as well.
Yeah, it kind of highlights the the opportunity for planning ahead. One of the things that you started out our discussion with today is obviously that's what we try to focus on, is plan ahead. Figure out what types of accounts you have available to you, what the rules are associated with those accounts, and say, listen, depending on my cash flow, my needs, my charitable intent, what's the best way for me to navigate this moving forward? And again,
no lazy days of summer here, Tom.
That's
right. I know.
But again, being 70 and a half or older in that inherited IRA paradigm is key too, which, I guess, to be honest, is not a big subset of inherited IRA beneficiaries these days, but,
I've seen it happen though. I've seen it. And we've used it. So, and now I think, what is the percentage of tax filers who actually itemize? I think it's something like only 10%, maybe like less than 10%, right?
Yeah. Ever since the Tax Cuts and Jobs Act back in 2018, and then the subsequent One Big Beautiful Bill Act that essentially kept that big standard deduction in place.
Yeah, it almost doubled it, right?
Folks that are itemizing has certainly declined. So that's where this planning comes in terms of, people think about giving to charity and taking a deduction. Well, the way the math works these days is,
it's hard to get above that hurdle.
Yeah,
that standard deduction.
What I need to give in order to be able to deduct that, and that's a much bigger number these days.
Right, and that's kind of where some of those bunching strategies come in. So maybe you can itemize in certain years, but that hurdle is pretty high, and you got to jump over it. So what we're seeing is, most people, and especially retirees, hey, maybe I was a business owner, maybe I was itemizing when I was working, but now I'm a retiree. I can't get over that hurdle. So I'm not itemizing. And, QCDs, this is where it gets even more exciting, is you don't need to be itemizing to take advantage of this. So I think this increases the pool of individuals who might be able to take advantage of this strategy.
Yeah. And part of it is just raising awareness that this strategy is out there, right? Some people just don't even know that there's a qualified charitable distribution, solution here. And it really can work quite well, to your point.
Yeah, I think people get scared by the letters. More letters.
Yeah.
So you want to talk about the AGI for a sec?
Sure. So,
kind of like the impact on.
Yeah, we touched a little bit on this before, but, it bears repeating that, QCDs, they are excluded from income. So they don't get added to your adjusted gross income when you're, doing your tax planning for the year or preparing your taxes. And so, it's not, if you didn't do a QCD and let's say you're in the RMD age, world, that income would need to be added to all the rest of your income that we talked about before. And that, depending on your particular situation, that can have a lot of knock-on effects on, a bunch of different things, including what tax bracket you happen to be in, your marginal bracket, right? It can impact the amount you pay for Medicare Part B and D premiums, that income
That IRMA.
adjusted amount that we call IRMA, right? Another
More letters. Right.
But this is a way to essentially plan and have an understanding about how this does or does not impact your adjusted gross income. If you're doing QCDs, you're not adding more income on top of the rest of your income.
Yeah, and especially with OB3A, there seem to be even some more deductions that are kind of AGI related in there, right? So keeping that lower, could have a great impact even on what you might be eligible for in terms of deduction.
Well, that reminds me, your point about OB3, and now that it's 2026, one of the key rules that kicked in starting this year was, from a deduction standpoint,
the floor.
Now there's a 0.5% of adjusted gross income floor.
Yes.
Essentially a hurdle that you need to. So if let's say you do the math on your AGI and the floor happens to be $5,000, and you're planning on giving the $5,000 to charity. Well, you wouldn't be able to deduct that, so you'd have to give more than $5,000 in order to get above that hurdle rate. So that's a new rule just to keep in mind. Moving forward.
Right, in terms of what you're able to deduct.
Absolutely.
Exactly. So like on $100,000 AGI, essentially if that 0.5% floor, the first $500 of giving would be a wash, more or less, right?
Yeah.
So yeah, that's another tricky point. And honestly, just more confusing.
Well,
right?
it is, but I think, it also just goes back to, people are still getting a benefit through that much larger standard deduction, right? That continues to increase.
Sure.
So that does increase year over year, which is a big benefit to a lot of taxpayers. But it also highlights the fact of, if you're going to itemize, that you need to beat that standard deduction level in order for you to, essentially benefit from itemizing versus using the standard deduction. So it just, again, this goes to planning, right? As you're kind of going through the year and how your income's looking, just taxpayers just need to kind of pay attention to what would provide a bigger benefit.
Right. And so again, this all kind of feeds back to this point about, QCDs helping to exclude that amount from taxable income. And hey, for the right person, that meets all these criteria and that works with their team of advisors, their financial planner, their CPA, and maybe their estate attorney, that, hey, this might be a tool to kind of help smooth the income from that IRA over time, as long as they're eligible.
Yeah.
So let's, all good things, it seems too good to be true, right? So there's got to be some caps on this, right? So let's talk about that.
Oh, here we go. Now, all right.
Here it is. There's got to be, all good things need a cap, right?
So
there's got to be a limit. It's generous. That is a generous amount. So the 2026 limit is a max of $111,000 per person and index for inflation. So this is the 2026 amount. So a couple of things I want to highlight here. So this is per person, right? So if you're married filing jointly, this QCD amount of $111,000 per person. So for a married filing jointly couple, that could be $222,000, assuming that, that's coming out of the IRAs and going directly to a charity. What you can't do is, let's say Sally and Jason have both big RMDs and they both want to do this. And Sally says, I only want to take $80,000 from my RMD, but we can do $222,000. And so Jason's like, oh, well, I'll do $142,000. Not so fast, right? Again, you've got to watch out at that cap per person. So it's at $111,000 per person for 2026. So just another kind of heads up there, right?
Yeah, a big benefit. And if a married couple has a lot of money in IRAs, then this could be a big benefit. Again, if they're charitably inclined. Yep.
And then just to be aware of, we're not going to spend time on this, but there is also this one-time $55,000 to a charitable remainder trust. More letters coming at you, CRT, or charitable gift annuity, a CGA. hey, there could be more costs in here. Maybe an estate attorney's involved with this. But just to point that out as well.
Yeah, it's a totally different animal. I guess it could work in some situations, but it's again, the one time means once in a lifetime. That's it. If you do this, that's the only time you can do it.
One and done. One and done. That's what you get.
You typically see people just going the standard QCD route and giving money directly to a qualified 501c3 charity.
Yeah. And so, hey, this must be completed within the calendar year. So when you first turn 73 and you have your required begin date, and that required beginning date is April 1st of the following year, but only for that first year. And that's not April 15th, that's April 1st. And we have a whole pot on RMDs. There's no grace period here with qualified charitable distributions. The funds must be sent from the IRA account directly to the charity within that calendar year for it to count to that year. So just be aware of that.
Yeah, in terms of, so we're talking about, obviously taxes on the federal level. Pay attention to your state rules, as they can certainly differ from state to state, and what the federal tax law says about qualified charitable distributions.
Right. And I think that's a really solid point to make here, is that, this is for, on the federal level, but, watch out, because states have their own set of rules for sure.
And, if you're a IRA owner who is engaging in using QCDs as part of your strategy, you need to get proper documentation from the charitable organization acknowledging receipt of the gift. And that's a standard operating procedure. Basically, it's not a big deal. Charities obviously know about the QCD set of rules, right? And they're encouraging IRA owners as possible to think about it and engage in that type of planning. But just having that letter and saving that in your files as you go through your tax preparation, and just noting that the gift was there's no receipt of any goods or services in return for that gift. So just something to
that's a great point.
In their file, absolutely.
Maybe we take a second just to kind of talk about the steps or the logistics of getting the QCD from start to the finish line. The first step's going to be, as we mentioned, review with your team, right? Your CPA, your CFP or FA, and then maybe your state attorney, right? And then it's contacting, making sure that the QCD fits into your overall plan. And then, checking with the custodian as to what is required. As you mentioned, there's usually paperwork, right? Making sure that charity is qualified, making sure that custodian is sending the funds directly from the IRA to the charity, making sure, as Tom mentioned, get those receipts, get that contemporaneous letter from the charity confirming it. And as Tom mentioned, I think that's a great point, making sure that there weren't any goods or services received. If you're getting a trip to, the islands based on this very generous charitable gift, well, that's questionable, right, Tom?
Yeah, that's right. This is true gifting to a charity with nothing in return.
Right. And then, you'll get that 1099-R. There have been some recent changes in terms of how custodians are starting to reflect QCDs, Tom, I'm hearing. There's, it's the QCD, it is Y and 7, and the code Y on the 1099-R can be associated with the QCD, and the code 7 is kind of like your normal RMD. So watching for those changes that are coming from the custodians, making sure that they're properly coded, and then working with your tax advisor is going to be huge here.
Yeah, good point. And having that letter, if the custodian just lists it as a regular distribution, that's your proof that you gave that money to charity, and you have to work with your tax preparer to make sure that gets incorporated into the tax return.
If you're still making contributions, we alluded to contributions in terms of this simple, more if you're making contributions to a simple IRA, you're not, or a SEP, you're not eligible. That's not an eligible account. Here's kind of a different story, more of a watch out. if you're still making contributions to your traditional IRA, just watch out, because that tax deductible contribution, essentially the amount of that would reduce the amount of the QCD. So just kind of a watch out there.
Yeah, it's a rare circumstance, but they did change the rules. So folks that are 70.5 and older and still have an IRA and still have earned income are allowed to make contributions. And this really applies to if you're making a deductible contribution, to your point, right?
Right.
A lot of people make contributions to IRAs and a lot of them aren't deductible. That's a different story. But here we're talking about deductible IRA contributions. So you'd have to factor that in and offset that amount from the QCD amount.
Great. Do you want to take this next one?
Sure. So the IRS considers the first dollars out of your IRA, if you're RMD age, to count towards your required minimum distribution, which means, it's typically it's a taxable event, right? So if you're going to be doing a QCD, the timing here matters, right? If you're doing a QCD, you should be lining up those QCDs at the outset of your distribution so that they help offset the total R&D amount for the year, which also helps to reduce your total taxable income. So I guess one example we would make here, Kate, would be, suppose somebody's R&D is $50,000, 50, right?
Right.
And, they're thinking about, how they're going to do it and when they're going to take those distributions through the year, because you can take them up to, the end of the calendar year, except for that first year quirk that you mentioned before. And let's say, maybe they weren't paying attention to when they were going to do a regular distribution versus a qualified charitable distribution, because some people might just say, hey, listen, if I might just want to give 25,000 of my $50,000 RMD to charity, in which case you would report 25,000 on your tax return, right? And 25,000 would be excluded from income. But, let's say, you took the first couple distributions because you took a few pieces here and there, and let's say you took out 20,000 and you put it in your bank account or just another investment account. That's taxable income, does not count towards your QCD. And then if you took out a subsequent distribution, $10,000 to a charity, that would further help reduce your RMD for the year, but only that 10,000 would be, eligible. So the rules here say that, first dollars out count towards your RMD. So if you're thinking about doing a QCD, you should be doing those QCDs first before you, let's say, take any of that RMD for yourself. And that will help reduce your taxable income. And I guess
right.
the extreme version, that would be, if I took the full 50,000 out, right, satisfied my RMD for the year, and I didn't give that to charity, that's taxable income, got to report it on my tax return. And then let's say, then I decided, oh, you know what, maybe I do want to support it.
You watch our podcast, you say, this is a great idea.
The wheels are turning. And you say, listen, I'm going to send $10,000 to a charity. That's great. It will not reduce the 50,000 that you already took.
That's a great point. And that's why we're doing this pod now. So hopefully people can, watch this, plan ahead. I know a lot of people delay taking required minimum distributions until year end, and or are planning for the following year. So it's great just to kind of make sure that you've got that runway. Don't wait until December. Right. Yeah, and that's the other thing too. A lot of these custodians have cutoffs, right, to do these QCDs. Because remember, you got to do the QCD, make sure the charity gets it, get that letter to make sure that it's going to be effective for that calendar year.
Yeah, Kate, that's a good point. And I guess we should just, make a comment about, the year-end crunch, right?
Oh, it's real. It's real.
Are, investors and IRA owners getting very, very busy towards the end of the year, but the custodians where your IRA is located are also getting a lot of, last minute requests to make these distributions. So it is important to, plan ahead and make sure you give yourself enough cushion so that you're not in a situation where, you're just, you're crossing your fingers that the distribution will be done in time.
Right.
So, as we sit here, we have 6 months, the full half, second half of the year ahead of us to plan for these types of distributions, to kind of get your ducks in a row so that, your plan can be executed in a timely manner.
That best efforts term always makes me a little nervous, I want to know it's done. I don't want best efforts. I want done. So
Yeah.
Great. Well, let's walk through maybe just kind of like a really simple example. Again, we're not CPAs, but let's just walk through like a very simple kind of
Sure.
process here. So let's say Sally, right? Sally is 76, so she's faced with required minimum distributions. Let's say her required minimum distribution is 30,000 this year, right? Let's say Sally has 70,000 of other taxable income, for argument's sake. So in this situation, let's say Sally didn't watch our podcast and she withdraws her 30,000 required minimum distribution. Remember, that's coming out fully as taxed, taxable income. And then she, before the end of the year, she always writes her $10,000 check off to her, charity that she feels very attached to. And so in this scenario, Sally may or may not be itemizing, but let's assume she's not itemizing. So Sally now has, remember that 70,000 of other taxable income. She's taking her 30,000 RMD, and then she's writing the check for 10,000. Now, remember in the OB3A, there is one little change which allows taxpayers who are not itemizing for cash-only gifts to write off $1,000 above the line for charitable giving. So in this case, that would help Sally out. She would get to, take off that $1,000. So Sally would have about 99,000 roughly in taxable income here in this example. So, she wouldn't get a huge tax benefit necessarily from this 10,000 if she's not itemizing. So, in the event that she does the qualified charitable distribution, let's say she still has that 30,000 required minimum distribution, but instead she's sending that 10,000 from the IRA directly to the charity. So therefore she's reducing her income from 30 down to 20 from the IRA. Plus she has the 70,000, other taxable income. So maybe she's at 90,000 in terms of taxable income. So she's been able to, reduce her taxable income for the year by using this tool. And this was something she was already doing. So you're really, improving that tax outcome without really changing the charitable impact either, right? In both examples, the charity's getting 10,000, but Sally's getting that tax benefit of being able to reduce her taxable income.
Right. And I'd say, the question of, can I itemize or will I just be better off taking the standard deduction?
Right.
I would say because we've had these two tax laws on the books now for, several years. I would say most folks know what camp they're in, right? As long as there's no big changes in your income for the year, right? Most folks know if they're just taking the standard deduction and they're not even close to being able to itemize. And that's where, just having a good idea about, where your total tax picture looks like for this year compared to last year, comes in when you're thinking about making a QCD. Because it's just
so that call to the CPA is going to be key.
Yeah,
right. And really,
and I'd say maybe one of the bigger changes that started last year under OB3 is the higher SALT deduction. Where some people might qualify for itemizing if they're in a high tax state, high income.
Sure.
And let's say their property taxes are quite high, along with some other state income taxes and whatnot. Maybe you could qualify, but again, it just goes back to running some numbers and figuring out where you stand on that. But I think most people have a pretty decent idea of kind of where they sit.
Yeah. And again, oftentimes, the QCD is going to have, more of a tax bang for your buck than taking the distribution and then writing the check to the charity. So oftentimes, that ordinary income savings is more of a tax benefit, speaking very generally.
Right.
And of course, so
very generally.
Very generally, please consult your CPA. So why don't we talk about maybe some I know, you've mentioned a lot of these key kind of ideal use cases and who might be a good fit for QCDs, but why don't we go through that? So I think, oftentimes it's going to be someone who's, already charitably inclined, right? Don't let the tax tail wag the dog. Don't just do QCDs because you're like, oh, it sounds like a good idea. No, make sure this fits into your belief system. This is part of your what you're already doing. Make sure that this aligns, with your full picture and what you're already doing.
Yeah, I mean, it's an irrevocable gift, right? You can't, this is, people being generous with, the assets that they've built, and benefiting some organization that's doing something good in the world. So yeah, I mean, this makes sense for folks that are already in that mindset. And
you know what? That's a great point. It's an irrevocable gift. So guess what? Make sure you don't need the money that you're giving away because, you can give it to the charity, but then the charity can't give it back to you. So make sure that your needs are, taken care of. Again, this fits within the broader financial plan, and make sure that this is something that you can, afford to do as well. Just making sure that it's something that fits in.
It's, I'd say the other thing is, and this might be obvious, but just to make the point, because we're chatting and we might as well, right? Is you can do some one year, you don't have to do it every single year. It's not like if you start QCDs, you have to keep doing QCDs, right? This is an annual decision. What do I want to do with my assets and the distributions that I'm required to make out of my IRA? So, it could be, every single year you can make a fresh decision on what makes sense to your situation.
Tom, that's a phenomenal point. And I'm going to take it one step further. You also don't have to do the full 111,000 per person, right? You can do 5,000, right? You can do part of it. You can do something more Solomon-like. You don't have to do the full amount. So that's an excellent point. It's not all or nothing.
Yeah, that I'm glad you said that because the 111 we were saying that's a very generous amount, right? But you don't have to go that big.
That's right.
Charities are obviously they're happy to receive whatever you're thinking about giving, and it can be a much smaller number than that for sure.
Right, and so this really fits in for someone who's age 70 and a half plus. With required minimum distributions, who really doesn't need the required minimum distributions to meet their living expenses. So I think that's key, right? And that kind of goes back to that whole making sure it fits within your broader financial plan.
Mm-hmm. Absolutely.
And work with your team, right? As we've said a couple of times, work with your CPA, your financial planner, and maybe even your estate planner, just to make sure everyone is in agreement and everyone's on the same page and is aware of the strategy and its impacts and making sure that you're eligible and that you've met all the rules and requirements. So that's it for our letters. I think we're out of letters, Tom. We're out of letters.
Thankfully. Until next time. Until next time.
Sorry. So Tom, I think this is a great strategy that might work for certain individuals. So hopefully this was helpful to our listeners.
Yeah, and plenty of time to plan around QCDs if it makes sense for your situation. So, if it's something that is important to you, start thinking about it now and see if you can incorporate it into your plan. Great. Well, thank you so much for joining us. Again, we are Amplified Wealth according to plan. Be sure to like, subscribe, give us a thumbs up, and we'll see you back here soon. Thank you. Happy summer.